Hi, my name is Evelyn Jimenez, and today's tax tip is going to be about the Dependent Care Tax Credit. Now that most of the schools are out for summer, you might be sending your child to day camp. It's often a significant expense. The good news is you might be eligible for a tax break for the cost. The value of the credit day camp is a qualified expense under the Child and Dependent Care Credit, which is worth 20 to 35% of qualifying expenses, subject to a cap. Note, sleepaway camps do not qualify for this credit. For 2019, the maximum expenses allowed for the credit are $3,000 for one child and $6,000 for two qualifying child or more. Other expenses eligible for the credit include payments to daycare centers, nannies, or nursery schools. Keep in mind that tax credits are especially valuable because they reduce your tax liability dollar for dollar. $1 of tax credit saves you $1 of taxes. This differs from deductions, which simply reduce your amount of income subject to taxes. For example, if you're in the 32% tax bracket, $1 of deduction saves you only 32 cents of taxes. So it's important to take maximum advantage of all the tax credits available to you. Work-related expenses, for example, to be qualified for the credit, it must be related to the employment. In other words, it must enable you to work or look for work if you're unemployed. It must also be for the care of your child, stepchild, foster child, or any qualifying relative who is under the age of 13, lives in your home for more than half the year, and meets other requirements. There's no age limit if the dependent child is physically or mentally unable to care for himself or herself. Special rules apply if the child's parents are divorced or separated, or if the parents live apart. Credit versus FSA. If you participate in an employer-sponsored child and dependent care flexible spending account, FSA, you can't use expenses paid from or reimbursed by the FSA to claim the credit. If your employer offers a child and dependent care FSA, you may wish to consider participating in that FSA instead of taking the credit. With an FSA for child and dependent care, you can contribute up to $5,000 on a pre-tax basis. If your marginal tax rate is more than 15%, participating in the FSA is more beneficial than taking the credit. That's because the exclusions from income under the FSA gives a tax benefit at your highest tax rate, while the credit rate for the taxpayers with adjusted gross income gives over $43,000 is limited to 20%, providing you're eligible on your tax return. You must include the Social Security number of each child who attends camp or receives care. There's no credit without it. You must also identify the organization or the persons that provide care for your child. So make sure to obtain the name, address, and taxpayer's identification number of the camp. Additional rules may apply to the child and dependent care credit. Contact us if you have any questions. We can help determine your eligibility for the credit. Thank you.